about all of this debt that Americans are going into and what that means for the economy going forward, because my gosh, guys, debt is reaching new highs and there seems to be no way to correct that because inflation is causing everybody to spend so much money. So we're going to be looking at a little bit of the stats and a little bit of data just so you guys can see what's going on here and make some appropriate trading decisions in the future. Okay, so first things first, we're going to come over here, and this is from the Federal Reserve Bank of New York, and this is just telling you how much debt has been going up over the past year. Okay, it's quite surprising here in a few different ways. So we're going to start off with up here with the mortgage debt. Mortgage debt has been skyrocketing. People are putting themselves in more and more debt. They're trying to buy houses, and they're, of course, interest rates are high, so they're having to pack on so much debt just to do that. But here's something I find interesting. Back in 2008, people really learned the hard way that it's very difficult to maintain a variable mortgage rate, which means, if interest rates are low, you're paying a low amount on your loan that you use to buy the house. But if interest rates skyrocket, that means you're gonna have to pay more month to month to month for the price of that loan, basically. Well, because interest rates are so high, you can see this right here, up $121 billion in just one quarter, okay? Now, home equity line of credit, that's only up $3 billion. Normally, smart people don't take credit against their home because if they lose, they end up losing their home, of course. Now, you get student loan debt. This was a little bit more surprising to me, maybe not to you guys, but student loan debt has actually been going up throughout this time. It's gone up $9 billion, and I'm assuming that's just because people have continued to go to school, and that is the debt that's been adding up, because so far people actually haven't been paying down their debt. And actually, why should they? It seems like every few weeks we hear about something new about how people that have student loan debt, they might not have to pay for it. So what's their incentive to start paying it down if the government says, hey, well, we got you, man? So, keeping an eye on that. On top of that, we have auto debt. Auto debt is up $10 billion. Look at this. The annual change is up 93 because you could say car prices have come down a little bit. Not all of them. If you guys have been trying to buy a truck, rest in peace to you. But you guys can see auto debt and mortgage debt have been going crazy over the past year. But over the past quarter, auto debt has actually been going up quite a bit. I assume everybody that found those little bit of lower rates, people wanted to buy a cheaper car, but the used car market was trash last year. They're finally getting some opportunities here. Next, we have credit card debt. This is something that I thought was going to be a little bit more aggressive. You can see that quarter to quarter, we actually didn't have too much of a growth. It was zero. So that means it's probably less than $1 billion. Less than $1 billion in credit card growth for the quarter. But look at this. Annual change year over year. This is the largest one besides mortgage debt. For whatever reason, and I'm probably sure it's something to do with inflation, we are seeing credit card debt reach some crazy levels, and this is making household debt go berserk. On the other hand, here we have other, which is up another $5 billion. I don't exactly know what other was. I was trying to go through some of the data here and just figure it out. Nobody told me what it was, but this is also going up quite a bit, about $67 billion over the past year. Now, you can see in total, the debt for America, look at this, up 1,205. That's like trillions of dollars, basically. That is a lot of money being popped up here in total debt. And just in the last quarter, you can see how high everything's been going. And that's really because of mortgage debt. And I mean, that's pretty much it. Everything else is small beans when it comes to mortgage debt. When it comes to annual changes, though, it's mortgage, cars, and credit cards. Those things are just driving debt sky high. Now, you can go in here and try to see some of the percentages and delinquencies and stuff like that. You can see delinquencies have been coming down or going up based off of the specific type of debt. So you can see student loan debt delinquencies have been going down because nobody has to pay them. Home equity line of credit, that's been going up. So people have been defaulting and getting delinquent on that. Mortgage debt, that's been going up, delinquency. So we're not in any dangerous levels, guys, but you are starting to see these cracks and these warning signs here. Credit card debt going from 3% to 4.5%. That's a large change, even though it doesn't seem like it. 4.5% of people going delinquent. That's not good if you guys want good credit, because if you guys screw up your credit right now, there's going to be very little chance of you guys getting a new credit card during the next recession, unless it's some type of secured credit card or a credit card with incredibly crazy rates, in which case you're going to have to pay for it, and it's going to be very hard to build your credit back up. And then you got other, Other delinquencies up from 2, let's just call it 3% to 4.5%. That's not good as well. So overall, you are seeing more people get delinquent over the past year. Last thing I want to talk to you guys about here. Let's get out of here. This is the chart showing the total debt balance. Look at this, guys. This is all the way back in 2004, 2008. We were looking pretty high. Here we went back down during the recession years, 2010, 2012, 2014. 2016, we geared up, putting on more debt, everybody's spending more and more and more because they're all making a lot more money. Now, all of a sudden, you can see this is gradual. We've been through here before, but now we kind of had this huge point starting off maybe 2020, 2021, where debt has just been skyrocketing, and part of that has been the supply chain issues and a lot of the stuff going on with inflation. Inflation is really driving this up faster than we've ever seen. I wish I can kind of go back in time a little bit more, but because of inflation, you can see how high this debt is really going up. Especially you saw maybe here 2014, we kind of bottomed out. After that, we've been going higher and higher and higher. After COVID, boom, debt is just not looking good, and it doesn't seem like it's going to get better anytime soon. That's the bad part. We may even stall out here over the summer because of all the debt that we packed on last summer from the way the chart's going to be perceived, but debt doesn't seem like it wants to come back down anytime soon. So when these people can't pay back their debt anymore, this is going to lead to a lot of delinquencies and a lot of bad credit that's going to unfortunately follow people, for the next few years. So let me know what you guys think about this. Has your debt gone up? Have you bought a house and realized how much more you have to spend if you guys have variable rate? Let me know. Thanks.